Understanding ELSS Mutual Funds, a comprehensive guide to tax-saving investments. Welcome to StockRhino. Want to save taxes and grow your wealth at the same time? That's exactly what ELSS Mutual Funds help you do. In this video, we'll explain what ELSS is, how it works, its benefits, lock-in period, risks, taxation, and whether it deserves a place in your portfolio. What are ELSS Mutual Funds? ELSS stands for Equity-Linked Savings Scheme. It's an equity mutual fund that qualifies for tax deductions under Section 80C of the Income Tax Act. You can claim up to 1.5 lakh deduction per year, reducing your taxable income. ELSS invests primarily in equity and equity-related instruments across large, mid, and small caps. In short, it's a tax-saving equity fund with growth potential. How it works. Here's how it works. You invest via lump sum or SIP. The money is invested in diversified equity portfolios. There's a mandatory lock-in of 3 years, the shortest among all 80C instruments. After 3 years, you can redeem or stay invested for long-term growth. Benefits. The advantages of ELSS funds are tax saving up to $46,800 per year for highest tax slab. Shortest lock-in compared to PPF, 15 years, or FD, 5 years. Potential for higher returns since they are equity-oriented. Option to invest via SIP for disciplined wealth creation. Dual benefit tax savings plus long-term wealth growth. Risks and challenges. But remember, ELSS is not risk-free. It invests in equities, so returns are market-linked. Short-term volatility is common. In 3 years you may see ups and downs. Lock-in means you can't withdraw early, even in emergencies. Returns are not guaranteed, they depend on market performance. Performance example. Example, if you invest 1.5 lakh every year in an ELSS fund via SIP for 10 years, you could potentially build 3,035 lakh, depending on market performance, all while saving tax every year. Compare that to a 5-year tax-saving FD which only gives 67% returns. Who should invest? ELSS is best suited for salaried individuals looking to save tax under 80C, first-time equity investors who want a mix of tax benefit plus equity exposure, long-term investors, 5+ years, who can handle volatility, young professionals starting their investment journey. Taxation. Tax rules for ELSS are same as equity funds. LTCG, long-term capital gains, after 3 years. Gains up to 1.25 lakh per year tax-free. Gains above that taxed at 12.5%. Smart tips. Smart tips for ELSS investing. Use SIP mode instead of lump sum to spread entry risk. Stay invested beyond 3 years, ideally 57 years for better returns. Don't invest only for tax saving, see it as a wealth creation tool. Compare past performance, fund manager track record, and expense ratio before choosing. Avoid investing in multiple ELSS funds, 12 is enough. Common mistakes. Avoid these mistakes. Withdrawing right after 3 years, you lose compounding benefits. Treating ELSS as a substitute for term insurance, it's not. Panic selling during market volatility. Key takeaways. ELSS equals equity mutual fund plus tax savings under 80C. Lock-in equals 3 years, shortest among all tax-saving options. Market-linked returns, ideal for long-term wealth creation. Best for young investors and salaried professionals. Want to learn more? Visit our website.